Hello guys, welcome to the video. I am Sarvesh Kutti. I am founder of SSG Wealth, and in today's video we are going to understand why most retail investors panic sell during market crash and what the HNI investors do instead. Before starting the video, if you are interested in growing your wealth and creating generational wealth for yourself and your family, then do follow and subscribe to SSG Wealth Group, and also watch this video till the end. And if you like this video's content, then do give it a thumbs up and share your thoughts as well in the comment section below. Okay, so in this video we are going to understand the anatomy of a panic sell, why retail investors panic sell. So why reacting to headline destroys wealth? A case study on Sensex crash, AI panic and cost of emotional investing. Most of the retail investors invest whenever the markets are at a peak. And what happens is when markets are at a peak, the valuation are overstretched. And recently, when there was a news of this American company called as Anthropic, they created or they launched their Claude LLM for developers, and that was kind of a development level where most of the Indian IT companies, junior level or mid level kind of employees can be replaced with that kind of a tool. The panic hit the market, and a lot of negative news flow started coming in, and fear based selling happened in the IT sector, stocks and mutual funds by retail investors. And eventually, most of the investors sold at the panic low. And after that, what happened is market resilience came in, or usually after a panic selling, what happens is market resilience comes in, long term value is discovered by the market, rational recovery happens, wealth gets restored, and eventually the recovery peak happens again. So eventually what becomes true in the market time and again is that time in the market is more important than timing the market for your investments. Yesterday the market took a massive dive and the portfolio turned red. Sensex fell by 1,000 points, Nifty by around 300 points, and IT sector by around minus 4%. The crash was swift and severe. Investors watched their hard-earned savings evaporate in real time as indices plummeted. The immediate psychological impulse was to protect whatever money was left. The panic was fueled by specific narrative that the artificial intelligence is coming for the Indian IT sector, and the Indian IT sector and lacks of jobs that it employs is going to go away. And there was like a huge deluge of negative news around the IT sector. And everyday investors didn't just see numbers, they saw an existential threat. And by watching these kind of news, they were terrified and they logged into their apps and hit the sell button. Then the very next morning, the market bounced back, the crash stopped, and the exact same IT stocks that everyone was terrified of 24 hours ago bounced right back up. The existential threat vanished overnight, as if it didn't really vanish, but it felt as if that threat vanished overnight. So if you sold during the crash, you didn't escape the loss, you actually locked the loss in. So there are two scenarios that could have happened. If you had held on to your IT sector mutual funds and the dip had happened, you would have experienced a little bit of paper loss, which was temporary. But when it recovered, your NAV would have recovered again, or your portfolio value would have recovered again. But in most cases, for retail investors, they sold when the panic happened, and thereby realizing a permanent loss in their portfolio and also missing out on the opportunity of recovery. So, by reacting to fear, you converted a temporary valuation dip into permanent destruction of capital. You cannot participate in the next rally or recovery if you had sold yesterday during panic. So, while retail investors were hitting sell button, the smart money was buying the dip, which means that when retail investors panic, the entire asset gets transferred to institutional buying and FIIs and HNIs. So for every seller, there must be a buyer. So foreign institutional investors have been turning into net buyers this particular month, absorbing the panic selling from retail investors. Institutions ignore the daily headlines and focus on economic facts for their investing. So retail investors focus on these things. First, they focus on AI fear narratives or news based decision making. They focus on daily price volatility and TV news anchors. Whereas smart money focuses on core Indian economy, GDP growth data, and corporate fundamentals. Big foreign investors do not care about the daily news cycle. They look at the actual facts. The core Indian economy is incredibly strong. In fact, as per one data, India is amongst the top countries which will not be going into a recession for the next 20 years. So this is the kind of strong economic condition that India has right now. And for most of the smart money, this particular IT panic selling simply meant good companies were momentarily on sale. The stock market is a device for transferring money from impatient to the patient. Here you can see as a diagram that wealth creation in the financial markets is through time and discipline. The impatient capital of retail investors flows into the patient wealth of smart money, HNI, and FIIs. So the golden rule of investing is that patience pays. If your strategy involves checking your phone every morning and react to what news channels are yelling about, you are playing a game you cannot win. So you need to stop treating your hard-earned savings like a daily casino game. I personally know many people who have lost lakhs and lakhs of money, hard-earned money, because of futures and options trading or impulse investment decisions. So one should need to stop looking at the financial markets as a casino game, because you work too hard for your money to let it disappear, and because one bad day or bad week can entirely wipe out your capital if you are playing in the financial markets like a casino, like a gambling. And constant monitoring leads to emotional decision making, which leads to buy high and sell panic cycle. So what do you need is you need a system that grows wealth quietly in the background, where you can see this is like a castle and there is a moat around it. And whenever there is some kind of market volatility or news noise, this moat helps you to preserve your castle, which is your wealth. So instead of guessing, you need to build a fortress. You need a proper system that works whether the market goes up or down, protecting your saving and investing like the top 1% investors do. So stop guessing and start building. Join the Financial Fortress Masterclass. Learn the exact step by step method to protect your portfolio from panic and build real wealth. Click the link in the description and stop reacting to news and start taking control of your future. Also, we are offering free portfolio reviews for HNIs and high earning professionals. And if you're a business owner, we are also offering business treasury portfolio review. This is all free of cost, where we will help you to analyze your portfolio and find gaps in your portfolio so that we can optimize it based on your future goals. So go ahead, click the link in the description box and book your free portfolio review today itself. You will get an option to select the convenient date and time on which you want to do the portfolio review with us. So thank you so much. If you like this video, do give it a thumbs up and share your comments in the comment section below, and subscribe to our channel for daily wealth generation and growth insights. Thank you so much. Have a great day.